Okay, good afternoon, everyone. We have been looking at how this foreign exchange market works, right? So that is our topic. We will be continuing this one for some time, and then we will start monetary policy, right? So today, I'm going to discuss about the intervention in the foreign exchange market. Now, up to now, we were looking at how this foreign exchange market works and how this foreign exchange rate is determined and how this demand and supply works, right? So, today we are going to discuss about how this foreign exchange market could be intervene and manipulate the equilibrium exchange rate, right? Okay, uh, the first we are looking at is like how this a central bank can through its activities can change foreign exchange rate, right? Now the first one, the foreign exchange intervention and the money supply, right? I have given you here to see. Let's assume a very simple balance sheet of a central bank, right? Just to say, like there's also like a balance sheet, assume like that, and kind of T account, right? As usual, we talk about debit and credits. It's in that way. And you can see in the left side the assets of the central bank, and right sides its liabilities of central bank, right? If a central bank intervene in a foreign exchange market, what will happen, right? So you have to keep in mind, this is from Miskin's explanation. So it's basically, it's the balance sheet is of Federal Reserve, Central Bank of USA, right? So if you take this Federal Reserve balance sheet, you can see assets and liabilities. So left side is the assets. I have mentioned only foreign assets here, and liability sides, it's simply, for simplicity, like I have included currency in circulation, right? So for like, you can see the denomination, right? It's foreign assets dollar and liabilities also dollar, because it's from Miskin books based on the US economy, right? So if you take Sri Lanka, the liabilities currency in circulation in rupee, right? And then foreign assets may be converted into Sri Lankan rupees, and you could see, right? Now, based on this accounts, now you can see, now if a central bank, right, think about the foreign exchange market, right? So you're getting inflows to the market, right? You are getting inflows to the market, right? You take Sri Lanka, so then you are getting more dollars to the Sri Lankan market, right? What will happen? Because the dollar supply is more, now the Sri Lankan currency will appreciate, right? Okay, now what central bank is going to do is it's going to buy foreign dollars, so foreign assets, that means dollars, right, to manage the foreign exchange rate, right? Or if it is other way around, right, Sri Lanka maybe, if the foreign inflows are not enough in the market, the Sri Lanka is going to sell its dollars, right, and buy, right, so sell its dollars and get the money back, right? Two things can happen, right? It's based on how we are going to, right, manipulate the exchange rate. Okay, now let's assume the Sri Lankans, okay, central bank, any central bank, this aspect, like they sell foreign assets, right? They sell foreign assets. So then let's assume 1 billion foreign assets they are going to sell. Then if you take the balance sheet, the foreign assets going to be declined by 1 billion. That is, we can say international reserve. So in central bank balance sheet, international reserves going to be declined. They sell foreign assets, then buy rupees, right? Buy rupees. So you have to see in the liabilities, right, what is going to be the liabilities. Now you have to understand, when it comes to money supply, if central bank issuing currencies, those are the liabilities of central bank. So currency is in circulation is a liability to central bank, right? So now they get the money back to central bank, Sri Lankan rupees, right? They give the foreign assets and get that. That means, like, let's think a practical example. The central bank is going to release the dollars to the market, so selling dollars and getting back rupees. So when you sell the dollars, your foreign assets going to be declined, and then you get the money back to central bank, your liabilities also decline, right? If central bank thinks there's a shortage in dollars and the value of currency is depreciating, right? So then the central bank should intervene and pump dollars to the market, right? So if they can pump dollars to the market, you can hold up with the exchange rate. Otherwise, what will happen, right? More demand in the market, so the exchange rate may increase, maybe from 150 to 180, right? To stop that, central bank can sell the dollars, so pump the dollars to the market and get the money back. In that instance, you are going to lose your assets and you are going to reduce the liability. That is the first table. Don't get confused. This table, as usual, right, it's from Miskin book, right? Other way around, right? If they want to buy dollars, what will happen? Foreign assets will increase and you have to pay by local currency, so liabilities also will increase, right? So now if somebody is buying dollars by using local currency, right, so that is the first table, right? Or like there's another alternatives, right? This foreign assets, that mean dollars in Sri Lanka, if somebody is going to buy by using deposits, so then the reserve will decline. is two alternative mechanism I have mentioned here. Now, either way, right, foreign assets going to be declined by 1 billion, and then the liabilities, it can be currency or reserves, could be declined by 1 billion, right? It's a sale of foreign assets, right? This is the intervention central bank tried to do it. Why central bank would like to do it? Because there's a shortage in the market, shortage of dollars in the market. If central bank let it go, then what will happen? There will be more demand for dollars, so it would appreciate. The dollar will appreciate, right? So on the hand, LK will depreciate. To stop that, central bank should intervene, because this we have seen that the appreciation and depreciation will have a huge impact on the economy, right? We have seen earlier, right? Okay, so as I said, you can see a central bank's purchase of domestic currency and corresponding sale of foreign assets in the foreign exchange market lead to an equal decline in international reserve and monetary base. Is that clear? Right. We have studied like what is monetary base, that is currency in circulation and reserve, right? Okay. So a central bank sale of domestic currency to purchase foreign assets in the foreign exchange market results in an equal rise in international reserve and the monetary base. I have said you, right? So it can be purchase, it can be sale, so that will affect your foreign assets and your monetary base, money supply. So this is the intervention. Why this intervention happen? Because if central bank wants to manage its foreign exchange rate, right, they have to intervene, right? Okay. This intervention can be in two ways, right? One is unsterilized foreign exchange intervention. Other one is sterilized foreign exchange intervention, right? First, we look into that. What is unsterilized foreign exchange intervention, right? Okay, the meaning of unsterilized foreign exchange intervention means, right? It means a domestic currency is sold to purchase foreign assets, leads to a gain in international reserve and increase in money supply. What will happen? And the depreciation of domestic currency, right? Now you can see, right? The domestic currency is sold to purchase foreign assets. So you are going to purchase foreign assets in Sri Lankan terms. Let's assume you are going to buy dollars. For that, you are going to sell your domestic currency. That's LKR. So you're going to pump LKR into the market, right? So when you pump to LKR into the market, money supply will increase. So then domestic currency will depreciate, right? So that means you have more than the demand in the market, right? Okay. Now you can see here what will happen. Now, in this graph, you can see the effect of an unsterilized purchase of dollars and sale of foreign assets. Step one, a purchase of dollars decrease the monetary base, right? Purchase of dollars decrease the monetary base. and the money supply, raising domestic interest rates and shifting the demand curve to the right? If you take Sri Lanka, and this explanation is based on US economy. If you take Sri Lanka, right, you are going to purchase, right, let's assume, okay, local currency. You are going to purchase local currency and sell dollar, right? You have to understand the differences. That's what I usually say, right? Always keep in mind, right? This is based on US economy, right? Okay, now if you are going to purchase local currency, and then when you purchase or get the local currency back due to sale of foreign assets, right? So you purchase local currency, what will happen? Monetary base will decline, right? Decrease in the monetary base and the money supply. So when the money supply decreases, the interest rate will rise, domestic interest rate, because now the less money supply and more demand. What will happen? The local domestic interest rates will increase. Then that will shift the demand curve to the right, D2. Right? So when the demand curve shifts to right, leading to a rise in the exchange rate to E2. Right? Now, what will happen? Your value, right? Your value of rupee will increase from E1 to E2. Earlier, if it is 150 rupees per dollar, now maybe 130. Clear? So now, this how the unsterilized intervention affect the market. Clear? Okay. Any questions out of this? Is that okay? You can message if it is yes. Okay. Next, you can move on to sterilized foreign exchange intervention. Now look at that. Now we earlier discussed that's unsterilized intervention. Like central bank sell or buy foreign assets and then through its reserve, right? Make the payment or receive the payment through its monetary base. Now that has like effect on money supply. That's what we have seen, right? When the money supply changes, that will affect other economic variable, macroeconomic variable. So central bank wanted to do this intervention. Let's assume central bank wants to do this intervention without affecting the money supply. What they can do? There can be two legs, right? One leg, they sell the central bank sells the foreign assets and buy back the local currency. Simultaneously, same time, central bank can sell again its local currency and buy bonds through open market operation. Then, if they can do it for same amount, because one, when they sell foreign assets, they are buying local currency, and when they buy local assets, they are going to sell their local currency. That means the ultimate effect is you are going to lose foreign assets by 1 billion, and now you got government bond local assets, it's 1 billion. That's what it's minus 1 billion in foreign assets and plus 1 billion in government bonds. So in that way, you can make the changes in the monetary base into zero. Now there's no impact on the money supply, but there's an impact on the foreign exchange market, right? Because we have pumped $1 billion assets into the market. Clear? So we call this one sterilized foreign exchange intervention. So as I said, to counter the effect of the foreign exchange intervention, conduct an offsetting open market operation. What is that open market operation? Buying and selling government bonds, right? Or specific bonds. Here, I assume it's a government bond, right? So there's no effect on the monetary base and no effect on the exchange rate, right? So you can keep, right, exchange rate without volatile. Is that okay? Okay. Now, up to now, we have seen how that foreign exchange market works, and then how a central bank can intervene, right? So intervention may be in two ways. One is unsterialized, other one is sterilized intervention, right? Okay, clear. Now, this, as we discussed, this foreign exchange, it's always, right? So the inflows and outflows between the economy and outside of the economy, right? So any intervention, any policy changes will affect those flows, right? The fund flows between two countries or the particular economy and rest of the countries. To see the first, like, what is the flow, fund flows, or how much is the fund flows between the specific country and rest of the world, right? To analyze that, we need to understand balance of payments. The balance of payments is an account that record all inflows from rest of the world and all outflows to the rest of the world from a specified economy. Basically, a bookkeeping system used to record all receipts and payments that have direct on the movement of funds between nations and foreign countries. Clear? Right. If you go through this balance of payment account, the real account, you can see there are two set of segments in that account. One is current account, other one is capital account. Any transaction which occurs in recurring nature, that is coming under current account, right? So now let's assume like trades between countries, right? You are like exporting and we are importing and same thing. So when you export, you will get foreign exchange inflow. When you import, you just have foreign exchange outflow. Like that, at the rest of the countries also, they will have those kind of transactions. So this is like this is occurring like regularly. So this is coming under current account. So the whole gamut of import and export, and if you take net export, that is the trade balance under current account, right? And capital account, that can be net receipt from capital transactions, right? Basically investments motives, right? So if you take some of these two, is the official reserve transaction balance. Now if you take all these together and could see what will be the changes in the official reserve held by Central Bank of Sri Lanka or any central bank, right? So now you can take balance of payment as an account that record inflows and outflows of foreign funds, and finally you can take the balance, that's what is balance of payment, take the balance, and that is positive, then your official reserve is going to be increased, and if that is negative, so then you are going to use your official reserve to set off those negative, right? So always the balance of payment is key for this foreign exchange market function, right? Because all these transactions, what is happening in the foreign exchange market, that's because of these transactions. Clear? Okay. Okay, just a question. In a global perspective, should we worry about the large US current account deficit? We all know like US is having large amount of current account deficit, right? So maybe the case in Sri Lanka, right? You can see the balance of payment of Sri Lanka and see what's happening to current account regularly, right? Continuously, you can see the deficit. So is it problematic one? So that's a question. Usually, if the balance of payment or current account deficit means it may be having two unwanted reasons or impact, right? So one, it indicates that at current exchange rate, foreign demand for US exports far less than the US demand for foreign goods, right? So deficit means, special trade deficits means, now you are importing more than you export. That means the demand for your product, your local product, is far less than the demand for foreign products. That means we are going to export less and import more. So that is an unfavorable incident or situation. And second, a current account deficit means foreigners' claim on US asset is growing, right? So that means if you are continuously having current account deficit, that means the foreigners, their claim on the US or local assets is going to be large. These two are not welcome normally, right? So the answer is, should we worry? Yes, because of two reasons. One is our local products are not competitive enough, and then there may be more claim on our local assets. Okay? Yeah. And then just to give some thoughts, the exchange rate regimes can be a different between countries' economic structure, based on countries' economic structure between countries, right? Okay, so some countries can follow fixed exchange rate regime. Some countries can follow floating exchange rate regime, or some countries may be managed float, right? It called dirty float as well, right? Okay, now what do you mean by fixed exchange rate? So value of currency is pegged to relative to the value of one other currency, anchor currency, right? You just stick to one currency. You stick to one currency, right? Okay, that means like you're going to fix your exchange rate with another currency. Now you can fix saying like, okay, $1 is equal to 150 rupees. You fixed it. That means pegged, right? So whatever the instances, you are going to keep that rate without any fluctuation. That is fixed exchange rate. So you could see like before World War One, like always the currency was fixed with the gold, right? So that's a gold era, right? So after World War, it slightly changed. Now the country started to peg with the US dollar, right? And then some countries later relaxed, and we also relaxed. Sri Lanka also relaxed its. Earlier it was like fixed exchange rate regime, and then we move on to floating exchange rate, right? Floating exchange rate means value of currencies allowed to fluctuate against all other currencies. So it's market determined, right? It's not pegged, it's market determined. So the value of the currency or rate is determined based on the supply and demand of the foreign currency. That is floating. The only drawback in this floating exchange rate regime is you just give up. So the volatility might be very high. Sometimes it can go up to 180, then come back to 150. Then what will happen? If the volatility is very high, the economic agent cannot make the decisions whether to buy or not. Today, there may be one price and tomorrow may be other price. If you are going to import raw materials from foreign countries, today may be one price and tomorrow may be another price. So economic agent cannot plan how to purchase, what to purchase, and how much to purchase, and what to sell, and what is the selling price. Nobody can decide. So in a strong economy, right, maybe you try to fix the exchange rate. But in a weak economy, or like if there are microeconomic imbalances, then, right, it's very difficult to, right, fix it. But then you have to float, you have to allow to float. But only thing is that also risky. Then what we can do is, wherever like you see exceptional fluctuation, you can intervene to the foreign exchange market and bring the exchange rate at desired level. That is we call managed float or dirty float. So attempt to influence exchange rates by buying and selling currencies. This is what we discussed earlier. Or sterilized or unsterilized. You can intervene buy, or any central bank can intervene and buy or sell currencies. Buy foreign currency and sell local currency, or sell foreign currency and buy local currency. Through that, they can try to manage the foreign exchange rate, right? Only thing is, like they can do it, but they can do only a certain level, right? Let's assume if you are going to manage your foreign exchange rate by selling your foreign assets, maybe dollars, you are going to be left with a little international reserve. If you can continuously do this one, selling foreign currency to the market and getting back your local currency, after some time you won't have your international reserve. Then what will happen, right? You can't intervene because you don't have the foreign assets. Same times it may be a huge burst to the economy. Clear? Okay. Okay, as I discussed, I have explained here as well. When the domestic currency is overvalued, right, the central bank must purchase domestic currency to keep the exchange rate fixed, right? It loses international reserve, right? They have to sell international reserve, right? And then they have to buy domestic currency. Then they can conduct a devaluation, right? When the domestic currency is undervalued, right, central bank must sell domestic currency to keep the exchange rate fixed. It gains international reserve, right? Okay, so it's called conduct a revaluation, right? So based on your local currency, whether it's overvalued or undervalued, so you can decide whether to sell or buy and fix the rate, right? When you sell or buy, the currency, local currency, may be devalued or revalued. Now we just see this based on a graph, right? Intervention in the foreign exchange market under fixed exchange rate regime, right? Let's think about the regime is fixed. That means you are going to peg, right? You are going to peg to another currency. Let's assume if it is Sri Lanka, or like you're going to fix the exchange rate, or $1 is equal to 150, right? Let's assume in US, right, they peg, right? Okay. See the step one, like you can see your y-axis, it's exchange rate, foreign currency per domestic currency, and then y is quantity of domestic assets, right? Okay, now look at this. The exchange rate is overvalued at E par, right, and would fall to E1, right? So you just overvalued your currency and set it for E par, right? Now it will fall to E1, right? So what can we do? Step 2, to keep the exchange rate at E par, the central bank purchased domestic currency to shift the demand curve to D2, right? So now you have to purchase the domestic currency. Then what will happen, right? Your demand will go to D2, and again you can reach your pegged rate. That means E par, Is it clear? Okay, when the central bank purchase the domestic currency, what will happen? So demand will increase, right? When the demand increases, you will reach to EPA again, right? So always you have to play around and you have to keep always with the EPA, right? That is the fixed rate. Okay, in other hand, let's assume we earlier talk about the overvalued exchange rate. Now what will happen to the undervalued exchange rate? Now your fixed is like your rate fixed at EPA, right? The step one, the exchange rate is undervalued at EPA and would rise to E1. What will happen? It will rise to E1 because it's undervalued, right? So when it rises to E1, what will be the step two? To keep the exchange rate at EPA, the central bank sell domestic currency to shift the demand curve to D2, right? So the central bank, what will happen? Sell domestic currency, right? When the central bank sells the domestic currency, then demand curve move to D2. Then again, the exchange rate would be set at EPA, right? In a fixed exchange rate, that means you want to keep the exchange rate fixed, so you can buy foreign assets or sell foreign assets. Through that, you can manage the exchange rate. But whether you are going to buy or whether you are going to sell, it's based on whether your currency is overvalued or undervalued. Right? Clear? Okay. Now you can think of European monetary system, right? 8 members of European, right, economic members of European Economic Forum fix exchange rate with one another and floated against the US dollar, right? You can see among them, right, they follow fixed exchange rates with one another and floated against the US dollar, right? Now within this European Union, like member countries, value was tied to basket of specified amounts of European currencies, right? So they have certain limits, they can fluctuate it within that limit, right? Almost, even though we say fixed. Lead to foreign exchange crisis involves speculative attacks. To illustrate, consider the market of British pounds in 92, right? Now the problem is like within the European monetary system, right, those member countries, their currencies against each other is fixed with some degree of fluctuation limit, right? So they can fluctuate within that, right? Okay, but now we can see what happened in 92, right? In British pounds market, right? Due to the speculation, right? Let's see. Now this is exchange rate, right, in y-axis, and x-axis it's quantity of British pounds assets, right? The increase in German interest rates shift the demand curve to the left, right? So what will happen? Now D1, the sterling pound demand curve, right? And then the fixed at 2.778 EPA, right? it was the case. Now assume like German interest rate increases. Now the demand for German assets increases, right? What will happen to the British pound assets? So it's going to decline. So shift the demand curve to the left, right? If they are going to shift the demand curve to the left, you are going to, your exchange rate going to be at E2, right? In step 2, the expectation that British pound would devalue shift the demand curve further to the left, and people also may be thinking, so British pound is going to be devalued, so that also will shift demand curve further, right? This is the speculation results, right? Because of the German interest rate increases, the automatically British pounds will decrease, demand for British pounds will decrease, and further expectation on devaluation, that will move demand curve to more left. So that means the exchange rate would be at E3, right? So now what's the problem? The step 3 requiring a much greater purchase of British pounds to shift the demand curve back to D1. So the British, they have to purchase more pounds from the market to pull this exchange rate to EPA, right? So this is the problem when you have like exchange rate fixed. So you have to always work on to keep the exchange rate stable, right? Clear? Up to now, any question? This little bit technically, maybe a little bit very difficult to understand maybe, but you can ask any question, you can send a message. Yes, I can explain those. And this I also would like to show one graph here or chart, right? We call it the policy trilemma, right? Or we call it impossible trinity, right? Economy always wanted to have fixed exchange rate, free capital mobility, and independent monetary policy. These aspects economic policymakers always wanted to have: a stable foreign exchange, a free capital mobility, an independent monetary policy, right? These are three important targets for like policymakers, right? Objects, right? So let's assume now independent monetary policy, like whenever they wanted to stimulate the economy or in a recession time or whatever the situation, the monetary policy should be able to take decision independently, right? Free capital means across the border, capital movement can be free. You don't need to have any controls, right? So fixed exchange rate means like the exchange rate almost stable, right? You cannot have fluctuation, right? But the thing is, can you have all these three together? That's the question. The policy trilemma says you can have only two at a time, right? You cannot have all three in an economy. You can have fixed exchange and independent monetary policy, but you cannot have free capital mobility, right? Or you can have independent monetary policy and free capital mobility, but you cannot have fixed exchange rate. Or you can have free capital mobility and fixed exchange rate, but not independent monetary policy. It's a policy trilemma, right? I just explained. Now, let's assume a country is facing a recession, right? Or downturn. You want to stimulate the country, right? So how do you do, right? You reduce the interest rate, right? You reduce the interest rate. You wanted to country perform well, or you can, like, so you can induce the consumption, or you can induce the investment, so you reduce the interest rate, right? But when you reduce the interest rate, what will happen? The relative return of your currency is going to be declined. Then capital will move, because like there may be other countries, they will give better return, right? So when the capital move outside, what will happen to the exchange rate? It would change, right? Now you will be short of foreign assets, because that will be moving from the local country to foreign countries. So you will be short of foreign currencies, then that will have the impact on foreign exchange rate. So you cannot have fixed exchange rate, because that's going to be volatile. Clear? So like that. Now if you are going to fixed exchange rate, right, then you have to control your capital flow. You cannot have free capital mobility. We have to say, okay, you have to put some control on capital mobility and say you can't take your investment back, right? If you want to have independent monetary policy and free capital mobility, you cannot have for a fixed foreign exchange rate. But if you want to have independent monetary policy and fixed exchange rate, you have to stop free capital mobility, right? If you want to have fixed exchange rate and free capital mobility, you cannot have independent monetary policy, because you can't change your interest rate to stimulate the economy. Clear? Okay, so this is the problem. Now I have given 3 examples as in the text. Now you can see the option 1, independent monetary policy and free capital mobility, that is followed by US, right? They have independent monetary policy, right, and free capital mobility. So between US and rest of the country, you can have capital movement, right? But right, they cannot have fixed exchange rate. It's always fluctuating, right? So you can take second option is Hong Kong. They have free capital mobility and fixed exchange rate, but not independent monetary policy. If you take third one, China, yes, they have independent monetary policy and fixed exchange rate, right? And there's no free capital mobility. They always control, right? So this is the policy trilemma we always call impossible trinity, right? Anybody want to achieve, they can achieve only 2 of these 3. Clear? Okay, so this is in line with the fixed and floating exchange rate. We also discussed impossible trinity, and then we are going to see managed float. Right? It's a hybrid, as I explained, hybrid of fixed and flexible. So small daily changes in response to market. So it's a lot small changes. But if there's a large fluctuation, there will be market intervention. Right? Rates fluctuate in response to market forces, but are not determined solely by them. Right? So we can see appreciation hurts exports and employment, and depreciation hurts imports and stimulation inflation. So this is we have discussed. Now, as I said, now capital controls. We can have capital controls, but that also we may be having problems, right? So if you are going to controls capital outflow, right, so you will have devaluation, and then that promote financial instability. That also seldom affect and may increase capital flight, right, because of the expectation, and lead to corruption as well if you have controls, right? Some extent, like people try to, right, come through shortcuts and make the capital, right, move from one place to other, right? And it also lose opportunity to improve the economy, right? Now, if you can control these kind of things, right, you are going to, right, you are not going to think about the space where you can improve the economy, right? You just control capital, right? So that means we don't think any avenues that can like promote economy and automatically, right, control capital flows. On the other hand, controls on capital inflows, right? If we can control inflows that lead to a lending boom and excessive risk taking by financial intermediaries, right? And then controls may block funds for production uses, right? If you can control inflows, what will happen? So there we may be having very good opportunities in the local market, very good production venues, but if somebody is going to block that inflows, then that also block the fund for productive uses, right? And produce substantial distortion and misallocation. Yes, if you are going to control inflows, that will promote misallocation because it won't find effective allocation of funds, right? You don't get the better return. And as I said, controls definitely some extent going to lead to corruptions. So actually, like, it's better to have a strong case for improving bank regulation supervision. Through that, you can manage some extent this issue, right? Okay, yeah. Okay, now what we are going to look at this international consideration and monetary policy, right? So monetary policy can be affected by international matters in several ways. As I said, now you have to think in a broader way, right? Now, any other countries, through their monetary policy, right, they can manipulate the exchange rates, right? In that instances, that also affect our local economy, right? If you take US, the current account deficit in the US state suggests that American businesses may be losing ability to compete because the dollar is too strong. Now, the US dollar is too strong. Because of that, the US products cannot be hold their competitiveness against other products, right? You can think of China and US, right? China control their exchange rate, right? Maybe undervalued, right? So keep their products more competitive in the international market. But the US, right? It's a free float. So then their dollar is more strong. So their product is very costly to the international market. That is the problem. So in other international economies or rest of the economies make the changes in their monetary policy and control the exchange rate, that will affect you. US deficits means surplus in other countries, right? If I am making deficits, that means what? Others are making surplus. That means they are having large increase in their international reserve holdings. That lead to what? World inflation, right? So we have to keep that in mind. And exchange rate consideration, a contractionary monetary policy will raise the domestic interest rate and strengthen the currency, right? The contractionary monetary policy means you are just think about your money supply is going to be string, right? Decline. When the money supply declines, your domestic interest rate increases, right? So that's strengthen the currency, our currency. But same time, an expansionary monetary policy will lower interest rate and weaken currency. So the rest of the economies, if they are making like that, if they are going for a contractionary monetary policy, if they are going for expansionary monetary policy, finally that's going to affect the exchange rate, right? So when the exchange rate is affected, that's going to affect the rest of the world as well. Okay. The final question is whether you are going to peg or not to peg, right? There's the question, whether you are going to fixed or not. So exchange rate targeting as an alternative monetary policy strategy, you can target exchange rate, right? We'll discuss monetary policy frameworks later, right? So one of the framework is exchange rate target, right? So you're going to target an exchange rate and you equip your monetary policy to achieve that exchange rate target. When you see advantages of exchange rate targeting, it contributes to keeping inflation under control, because like now you are going to fix the exchange rate, then whatever that like one example is like if you are going to import, the price is fixed always, right? If you like assume that other factors are constant, so then you can control your inflation. right? It's very simple and very clarity and automatic rule for conduct of monetary policy, right? But there are disadvantage of exchange rate targeting as well. You cannot respond to domestic shocks, and shocks to anchor country are transmitted, right? The problem is like if there's a shock in the domestic economy, if you take any action, that's going to affect the fixed exchange rate. That's what we saw in the trilemma, right? Impossible trinity, right? If you are going to take any action due to the shock in the domestic economy, that's going to affect your fixed exchange rate, right? And then open to speculate attacks on currency. Speculative attacks can happen always because they assume, okay, can you defend this currency at this level, right? Just push always, right, to move from your fixed exchange rate level. So speculators always will have an eye on that to make their profit. So then always try to attack. So weakens the accountability of policymakers as the exchange rate lost value as signal. So now you try to defend your exchange rate targeting, you always reach the target. But once you lose, then your credibility, right, will be foregone, right? And your accountability weakens, right? So these are the two things. You can have exchange rate targeting, or you can maintain, you try to maintain fixed exchange rate, but there are advantages, but same time that is risky as well. Clear? Okay. Okay, there's a question in the textbooks like when is exchange rate targeting desirable for industrialized countries, right? If you take industrialized countries, so they do more export imports, right? So when this exchange rate targeting desirable, right? So exchange rate target is desirable if domestic monetary and political institutions are not conducive to good policy making, right? Now the thing is like if the local economy has very strong, right, monetary institutions and political institutions, and they can make effective policy making, yes, of course, they don't need to have this fixed exchange rate, right? But if they don't have, so it's better they can fix it this and follow the rule. That's what it's very simple and straightforward. Are they important? Like very easy integration because your rate is fixed, so you can easily have the economic transaction with rest of the countries. So your integration is very easy and improved. Right, and when it's desirable for emerging market, right? So for emerging markets, if their political and monetary institutions are weak, then of course this is desirable because the strategy becomes a stabilization policy of last resort because they try to stabilize the rate, so they can follow this one, right? Okay, now up to now we have seen what is exchange rate market, what are the rates in markets, who are the players in the market, how these dates exchange rates are determined, and then what are the external forces that can change this exchange rate, and how a central bank intervened to manipulate the exchange rates. And in international activities, how that changes balance of payment transactions. And then finally, right, different regime of exchange rates and the advantages and drawbacks of those exchange rates. Okay, up to now we have seen the exchange rate analysis. I hope like you some extra understand, right? Or if you have any doubts, you can send me the message and I will take those questions. Okay, next, so we are going to see the monetary policy, right? Like this is our fifth discussion, and next one is our sixth one, so that I will be finalizing the next class, our areas. And if you want to ask any questions, you can send me the message during this class or next class. Okay, next one will be the final one, right? Okay, so I will move on to next area, that is monetary policy. I straight away go into that monetary policy area, right? To set the basic idea about policies. So I'm just going to discuss about microeconomic policy and how do you formulate microeconomic policy. Under that, we are going to discuss in detail monetary policy. In that monetary policy, we are going to discuss meaning and scope of monetary policies, monetary policy instruments and target variables, transmission mechanism of monetary policy, effectiveness and limitations of monetary policies, and how monetary policy is conducted in Sri Lanka. Okay, first of all, let me discuss with you what is microeconomic policy. The microeconomic policy is an attempt by the authorities to achieve particular target levels of certain major economic aggregates or goals, right? So you set some goals, right? It's a aggregate goals, right? It's a macroeconomic goals, right? To achieve that goals, you prepare some policies. That is microeconomic policy. So when I say macroeconomic goals, what are those goals? Maybe sustainable growth rate, right? It's a broader perspective I'm talking about. Or full employment, right? Or equitable distribution on national income. Maybe stable price level or equilibrium in balance of payment. These goals are microeconomic goals, right? Now, do you need a microeconomic policy? That's a big question. Now, if you could see, like before this Great Depression in 1930s, right? The economists thought like a little government intervention is enough, right? Or like there's no government intervention is required. Anything can happen through free market mechanism, right? So they follow like Adam Smith explanation. So free market mechanism is good for any economy. But after this Great Depression, the economists realized that if you want to stimulate an economy, right, you can't wait for free market to correct it. You have to take immediate action. Somebody should intervene into the market and correct it. So after Great Depression, government intervention on the economy gained prominence. So it's a Keynes opinion, right? So after this Great Depression, right, and World Wars, so rebuilding of countries affected by Second World War focused on Keynes' view. They believe that microeconomic policy intervention can solve the economic problems such as breaking the vicious circle of poverty and low equilibrium trap, right? And encourage capital formation and economic growth, solve unemployment issues, and reduce income inequality. So this can be solved through intervention. Now let's say, like as an example, like vicious circle of poverty, you know, like people who are under poverty continuously be under poverty, right? So it's like a circle, like their income is low, then their investment is low, so their return from investment is low, right? So again, so their investment is low, so then it's always their income is low, right? You have to break somewhere. You can break somewhere, like you can increase their investment by giving a loan or something, right? Additional funds, so they can invest more and they can get income more, then they can improve their lifestyle, or they can come out from the poverty. So there should be intervention needed for that, right? So you can have low equilibrium, but somebody should push up for the high equilibrium, right? And encourage capital formation, right? So if you want to encourage capital formation, you have to encourage savings, right? So some people, some institution can intervene and increase the interest rate, so people can save more. Or through that capital formation increase, so you can increase your economic growth. Or you can solve unemployment issues through improving economic activities. Or you can have some policies to reduce income inequality. So maybe fiscal policy as well, right? So after 30 years after World War, everybody thought, yeah, it's better to have some kind of intervention, right? So now that is getting prominence, right? And then what is the objective of microeconomic policy? It can be economic growth, like if you want to like improve the economic growth, you can have a different microeconomic policies. Or your objective may be high rate of employment, or your objective may be stabilization of price, output, and employment, or economic equity, or stabilization of balance of payment. Example, avoiding debt trap. So these microeconomic policies may have different objectives, right? Based on the objective, you can have different framework in an economy, right? Okay. When it comes to formulation of microeconomics policy, there are 3 steps we have to look into that. Determination of policy objectives. So we have seen there are so many policy objectives. What is your objective? That's a step 1. Second, we have to decide the choice of policy and policy instruments. Third, we have to determine the target variables and target. These are 3 areas. So now you have to keep in mind, when we are going to look into that monetary policy, you should know what is the policy objectives and what are the choice of policy and policy instruments, and what are the target variables and targets. Right? Okay. The step 1, determining target variables and targets, right? Okay. So the target variables or targets may be economic growth, high rate of employment, as we discussed earlier, right? So then you are going to write this determination are based on what? Policymakers' perception on economics or social and political problems of the country, right? And approach to the analysis and measures of economic needs and political compulsion. It may be biased towards political and economic thought, or skills and expertise in economic theory, logic, and tool. Now, what I want to say is here, when you determine a policy objectives, there may be so many factors that determine your policy objective, right? So sometimes why I'm saying this, sometimes your objectives, the selection of policy objectives may be not in line with your expectation ultimately. Yeah. Second, choice of policy and policy instruments. A policy and a combination of policy including followings: maybe fiscal policy, maybe monetary policy, or maybe income policy. You can choose. First, you decide your objective. Second, you are going to choose what policy you are going to stimulate, right? Are we going to achieve our objective through fiscal policy, or are we going to achieve our objective through monetary policy? So we have to decide. Only thing is that choice depends on the development level and structure of the economy. Example, the fiscal policy is effective if the banking system and capital market are underdeveloped. Because if you are going to implement monetary policy, that's going through the banking system. But when the banking system is underdeveloped, you don't achieve your expected outcome. So then you can most probably use fiscal policy. And assume like both fiscal policy and monetary policy fails. So policymakers directly control prices, wages, choice of industries, controls of imports and foreign exchange. So that happens, right? So then second, we have to decide the policy. Then we have to decide target variables and targets. If you are going to use monetary policy, we have normally target variables. It can be aggregate supply of money, aggregate demand for money, or credit created by banks, right? Those may be the target variables. If you're going to use fiscal policy target policy, then you can think about fiscal policy target variables. That can be disposable income or consumption expenditure, or saving and investment, or wealth holding of the people. Or you can decide which one is your target variable, right? Based on that, you can develop your microeconomic policy, right? Okay, now you had target variables. Now you can think about what is the policy instruments you are going to use it. If you take monetary policy instruments, it affects demand for money or cash holding of public. There can be several instruments, maybe bank rate, or open market operation, or statutory reserve requirement, and selective credit control. So we will discuss later. Just I am setting the background behind this macroeconomic policy, right? If you are going to use fiscal policy instrument, under fiscal policy, it can be a public expenditure, or taxation, public borrowing, deficit financing, or wealth holding of the people, maybe bond. So these instruments can be worked out. Okay, so now, up to now, we discuss about microeconomic policies, their objectives, and what are the instruments under each policies we can see, right? We discussed. But now we are going to discuss in detail about monetary policy, right? So what is mean by monetary policy and the scope of it, and monetary policy instrument target variables, and how that policy decisions transmitted to the economy, and then finally effectiveness and limitations of monetary policy. Let's look at that. First, what is monetary policy? A monetary policy is a program of actions undertaken by monetary authorities. When you say monetary authorities, let's assume central bank, to control and regulate the money supply with the public, right? And flow of credit with a view to achieve predetermined microeconomic goals, right? So what is monetary policy means, right? You are going to, that monetary authorities, they are going to control and regulate money supply with a view to achieve macroeconomic goals. So basic policy question is whether to increase or decrease the money supply, right? Okay, yeah. The scope of monetary policy is the entire area of economic transactions and the macroeconomic variables that monetary authority can influence, right? Therefore, it depends on the level of monetization of the economy. That means usage of money as a medium of exchange, and then the level of capital market development, maybe big banks or financial institutions and high volume transaction through capital markets. So the scope of monetary policy, that means like where this monetary policy can have influence, the area where this monetary policy can have influence depends on these two areas, right? Okay. Now we know what is monetary policy, right? The monetary policy instruments and target variables, we are going to look into that next. The economic variable that can a central bank can change at its discretion with a view to controlling and regulating. One is the supply of and demand for money, the availability of credit. Now, central bank can manipulate, right? Can make a changes on supply and demand for money, right? And then availability of credit, maybe how much we can borrow from banks. These are two things the central bank can change through its monetary policy, right? Okay, let's assume I just give you some background about Central Bank of Sri Lanka, right? Now, the Central Bank of Sri Lanka's objective, it has two main objectives. One is economic and price stability. Other one is financial system stability. The major one is economic and price stability, especially we talk about price stability. What do you mean by price stability? So the price level of the country should be stable for foreseeable future. You cannot expect, right, huge variation or volatility in the price. There is price stability. So the price level should be withstand with internal and external shocks. There is price stability. So to keep this price stability or price in a stable manner, the central bank conduct monetary policy, right? In other words, the central bank wanted to have low and stable inflation, right? When I say price level, so the changes in the price level, right? Continuous changes in the price level, we call general price level, we call it inflation, right? So then the central bank always wanted low and stable inflation. So this price level can be controlled through money supply and then available credit, right? So central bank can change this money supply and money demand, right? And availability of the credit. Through that, the central bank can achieve its objective, a price stability. That's what we discussed earlier, price level as a macroeconomic goal, right? So that is the central banks can do through monetary policy, right? So when it comes to monetary policy instrument, it can be categorized into two: quantitative measures and qualitative measures, or selective credit control. We said selective credit controls, right? Okay. First, we look into that quantitative measures. We call it traditional measures. The quantitative measures can be three. One is open market operation, we call it OMO. Second can be bank rate or discount rate. And third may be cash reserve ratio or statutory reserve ratio, SRR. Now, during this COVID-19 period, you might be heard about a lot of actions taken by central bank to stimulate the economy, right? As we discussed earlier, now central bank, like, right, after Great Depression, the economists were very well favor of intervention, right? So now one of these categories, like monetary policy, conduct of monetary policy, right, to stimulate this economy. Now the similar thing, right, after this COVID-19 pandemic also, right, economies are facing, due to this COVID pandemic, economies are facing lot of challenges. So like most of the central bank taking several measures to overcome this economic stagnation, right? Similarly, Central Bank of Sri Lanka also taking so many measures to stimulate the economy, right? So you can read a lot of articles or central bank publications about what are the activities taken by Central Bank of Sri Lanka. So many measures are taken. Out of that, you can see this open market operation, how the Central Bank of Sri Lanka has taken care of, and bank rate and SRR, what are changes they have done for these quantitative measures, right? Okay, so you all can read, you can go to central bank website and read the articles and see and relate it with the theory, so then you would be understanding better. First, look into that open market operation. What is open market operations? The open market operations means the sale and purchase of government securities and treasury bills by central banks. Okay, central banks. Now, as we said earlier, as we discussed, so central bank can manipulate the money supply, money demand, or credit creation, and then through that, they can stimulate the economy, right? So first, what they can do is through sale and purchase of government securities and treasury bills, they can manipulate or they can make the changes in the money supply, right? So when they make the changes in the money supply, okay, let's assume they increase the money supply, right? So like when they increase the money supply, the general public will have more money now, right? So they create more demand, so they can increase their aggregate demand. It can increase aggregate demand, so economic growth may be stimulated. So one of the reasons for open market operation during the crisis is increased money supply. Right? What's happening in open market? Open market operation, you are going to pump money into the circulation. That means you buy back government securities or bills and bonds, right? And give more money to the, let's assume you are going to buy government securities from the banks and public, or maybe, so you are going to give money. So money is going out from central bank, right? Okay, so you can remember the T accounts I show you. One side assets and one side is liabilities. So when you give more money, so central bank liability increases. Same way, your domestic assets increases, right? In your balance sheet, asset increases, that is you are getting bonds, right? Domestic assets, and same time your liabilities increases, you pump more money. So through that, you can increase aggregate demand and try to improve economic growth. Or it can be other way around. If you want to reduce the money supply, then you can sell government securities or domestic assets and get the money back. So when you sell domestic assets, the central bank balance sheet, you are going to lose the assets, domestic assets, and then you are getting money back, so your liability is going to be less. So both sides, right, you are going to have less assets and less liabilities. So open market operations is targets to reduce the money supply. Okay, now let's go for a 15 minutes break and come back and see these examples. Okay, we can start now. As we discussed, like central bank can influence money supply through open market operation, right? First, we will see what happened to the inflation, right? First example, let's assume central bank wants to reduce inflation. So through open market operation, central bank will offer government securities for sale through banks, right? So central bank call for an auction, and through that central bank will sell securities, right? So primary dealers can participate in that auction and buy securities, right? So people buy them through check. Let's see an example like that. People, they are going to buy government securities through paying by check. So what will happen? Money transferred from buyer's account to central bank account. So now the people who are holding their money in their bank deposits, that will move into central bank account, right? So what will happen? Reduce total deposits, right? When the total deposits decline, the credit creation capacity of the bank will decline, right? So what will happen? Decrease the flow of bank credit to the public. So when the credit facilities given to public will decline, right? So ultimately decline the supply of credit. So when the funds are not available with the public, which has been available through bank credit, now the demand for fund, right? Now let's assume like you have absorbed, right, the money with the general public into central bank, right? So now they are like ultimately the people left with the little money, right? So then automatically what will happen? The price will come down, right? Because if you take a goods market equilibrium, the supply of goods and demands of goods, now because of the fund shortage, the demand will decline, so then the price will come down, right? So automatically the inflation will be controlled. Is that okay? So now you have to see this example. So central bank is going to sell securities and absorb the liquidity from the market, or like in this example they get the general public deposits, so then the bank's credit creation will go down, so the supply of credit will go down, so ultimately the inflation will be controlled, right? Look at this second example. Okay, okay, so then banks reserves came down, so then what happened? The credit creation capacity of the banks going to be declined, right? That means decrease the flow of bank credit to the public. So ultimately, in this instant also, the credit supply is going to be declined. So finally, you are going to control inflation, right? This is the second example. In this example, you can see another effect as well. When you sell the securities, right? Let's assume as an example, there's a security right? Maybe bond, 100 rupee bond bearing 10% interest rate is sold at reduced price of 90 rupees, right? A bond is there, the coupon rate is 10%, but that is sold at 90 rupees with the discount. So what is the yield of that bond now? 11.11%, because like you can divide your investment. Yeah, you will get 10% bond, right? 10% of 100 rupees, that's 10 rupees as an income, and the investment is 90 rupees. So then your return is 11.11%, right? So when your interest rate goes up, right? So interest rate goes up, so demand for credit also decline. So two ways. One, like credit creation will decline. Other hand, demand for credit also will decline. So both can happen, right? Okay. But in other hand, let's assume central bank decide to increase money supply, right? Now, up to now, we have seen if central bank wants to reduce money supply, so then they sell bonds, right? So now this instance, central bank decided to increase money supply. What they can do? They can buy back government securities through banks. So people sell them. Then they get the security, the central bank get the securities and pump the money into the market. So it goes to the people's hand. So money transferred from central bank account to people account. People accounts in the banks. So that increase total deposits of the banks. Ultimately, that would increase the credit creations capacity of the bank. So banks can create more credit than earlier. So again, that created credit goes to general public, right? So that means increased supply of credit. When other things equal, right, given, flow of money from banks to public increases. Clear? So now, you know, like through open market operation, a central bank can decrease money supply or increase money supply. If the central bank wants to control inflation, they can decrease money supply, right? So either way, the central bank try to maintain price stability, right? Okay. The thing is, what we have to remember is, sometimes this open market operation may not be effective, right? Even though we say, like, you can sell the bond and get the money back, and then you think like desired objective would be achieved, right? That means like you create your you influence the credit creation capacity of the banks. Ultimately, you changes the price level, all right? But sometimes, even though you do open market operations, you won't be able to achieve the desired outcome, right? Okay, now let's assume if open market operation ineffective, right? Now, you think a central bank wanted to increase the aggregate demand. So then central bank wants banks to give more credit. So central bank tried to increase credit creation capacity of the banks. what they can do, right? They can buy bonds and funds money to the banks, right? Then their credit creation capacity increases. They can give more credit, people get more money, and increase aggregate demand. But if the banking system has excess liquidity, already they have sufficient money, but the only thing is they are not lending. In that sense, if central bank thinks if they can give more money, bank will lend more. No, it's not going to happen because banks are already with the sufficient money. So in that instance, then open market operation is ineffective. And second, a period of depression. Now there's an economic downturn, and like a depression seems to be economy is under depression. So even though the central bank tried to give or increase the supply of money, because of the decline in economic activities, the demand for money might be very less. Then even though you do open market operation, try to increase the money supply, there won't be no demand for credit. So in that instance, whatever you do, right, to increase the money supply is not going to work as expected. And third one, like when banking system and capital market are underdeveloped, right? Let's assume like now this happens, this transmission happens through banks, right? So if that is to happen very quickly, you have to have effective banking system and capital market. And if your banking system is very weak, it will take so long to have, ultimate impact. Within that, the whole scenario of the economy would change. So open market operation may not be effective. The banking system or capital markets are not developed appropriately. And fourth, popularity of government securities is not sufficient. Now, you are going to do open market by using government securities. And if the government securities are not popular enough, maybe not more people are willing to buy, right? So then your open market operation may not be effective. Clear? Okay. And up to now, we have seen open market operation. The second, the bank rate, right? Bank rate. What is meant by bank rate? The rate on which central bank charges on the loans and advances to the commercial bank. Now, commercial banks, if they need money, they can go to central bank and borrow money. To that borrowing, central bank charge an interest rate that is called bank rate, right? Now, if the central bank wants to increase the credit creation capacity of the banks, what they can do, right? Or central bank wants to decrease the credit creation capacity of the bank, the central bank can increase the bank rate. If they want to increase the credit creation capacity, they can decrease the bank rate. They can decrease the bank rate. Now let's assume now central bank wants to credit creation capacity to be increased. So the central bank, right? Central bank decrease the interest rate. Then banks can come and get more money, more loan from central bank, and their credit creation capacity would increase. If central bank increase the bank rate, then it's very costly for the banks to borrow from central bank. Then they don't borrow. So in other hand, they don't create more credit, right? So in this bank rate, see the effect. The effect one, right? When you increase the interest rate, what will happen? So market interest rate changes, reduce the net worth of government bonds, right? So we have already discussed, when the interest rate increases, the value of the bonds will decrease. When the interest rate decreases, the value of the bond will increase. That we have seen. Negative relationship. So here, when the central bank increases the rate, what will happen? The value of the bond will decrease. So when the value of the bond decreases, that reduces the commercial bank capacity to borrow from central bank. What will happen? So now your bond is valued less. So you can only borrow less amount from central bank. If they can borrow only less amounts, that means less cash reserve at commercial banks. So ultimately reduce the credit creation capacity of this bank. So flow of credit is reduced. This is effect one, right? What will happen? Effect two, when the central bank, right, increase the interest rate, what will happen? Bond price will come down. So commercial bank also increases the discount rate. Now commercial banks are, let's assume, buying bills, right? Let's assume import bill, right? So commercial bank also increase the discount rate, right? So that increase the cost of bank credit. Discourage the firms to discount their bills of exchange. So if they have huge discount, then the firms, they don't come and ask for discount, a bill. So if the demand for credit is interest elastic, right, the demand for fund is decreases, right? If the demand for credit is interest elastic, so then that means the small changes in the interest will have a big changes in the credit demand. That is the interest elastic. So if that is the case, then demand for fund is decreases, right? That's the second effect. And third, the bank lending rate is quickly adjusted to deposit rate, right? Okay, what will happen? Increase savings and flow into bank as deposits. Now interest rate increases, so banks increase the interest rate of deposit as well. So serving increases, when the deposit rates increases, definitely people serve more, right? And keep it in the banking system. So ultimately, money with public decreases. That is deposit mobilization effect. So you can see through bank rate also, the central bank can change the money supply. So when the central bank changes the bank rate, there can be three effects, right? One is effect one, right? That is finally the flow of credit is reduced. And second, effect two, the demand for credit is decreases, right? And third, the deposit increases, then money with the public decreases. So in all three ways, money supply is restricted, right? So streaming. So the central bank can change the money supply through open market operation and then bank rate. But the problem is there are limitations on using bank rate as well. The one is the commercial banks rarely borrow from central bank, right? So in very urgent basis only they borrow, otherwise they don't borrow. So the changing bank rate is not going to have much impact on bank's behavior, the bank's behavior. Second, share of banking credit has declined due to capital market growth. Now, up to now, we were looking at the banking credit, what will happen to the banking credit. But if you take the economies, developed economies, that the capital market caters a lot of firms, not banks. So if the firms want money, they go to capital market, not to the banks. So share of bank credit has declined due to capital market growth. So then the central bank, even though the central bank reduced the bank rate, so impact may be less because the firms are going to capital market. And finally, the bank rate is effective only when credit demand is interest elastic, right? Effective only when credit demand is interest elastic, as we discussed, right? If it is interest elastic, okay, when you reduce the interest rate, right, the credit demand will go up. But if it is inelastic, then it won't happen as expected. And third one, SRR, we call it SRR, or we also can call cash reserve ratio. What is that SRR, statutory reserve ratio? What is that? A percentage of total deposits which commercial banks are required to maintain in the form of cash reserve with central bank. All banks, commercial banks, right, they are required to keep a percentage of their deposit in central bank. That is we call statutory reserve requirement. They have to keep it. The central bank will announce a percentage, maybe 5% or 2% or 10%. So the other banks, they have to take 10% of their deposits and keep it central bank, or maybe 5%, maybe 2%. So now how central banks control money supply? Because like central bank controls money supply through SRR as like two ways, right? So if they increase the SRR, what will happen? Let's say you have a deposit of 10 rupees. If central bank says 10% is SRR, you have to then keep 1 rupee with central bank. You can only lend 9 rupees. Then 9 rupees going to public, right? If central bank says SRR is 20%, then you have to keep 2 rupees at central bank. Only you can lend 8 rupees. Control through SRR directly. Now this can be called like two ways: contractionary monetary policy or expansionary monetary policy. So when contractionary monetary policy or tightening monetary policy means like you are going to reduce the money supply. So then central bank rises SRR. Or expansionary mean like you are going to increase money supply, or expansionary or easing monetary policy we call it. So central bank is going to expand the money supply, right? So for that central bank reduces SRR. So then you are going to keep only little money in central bank with respect to your deposit value, and you are going to lend more money, right? So this is one of the measures or quantitative measures central banks follows. Let's see an example. Commercial banks total deposit, let's assume 100, SRR is 20%. Now loanable fund, how much? If they have deposit 100, they have to keep 20% with central bank, that means 20 rupees. The banks can lend only 80 rupees. Now bank is lending that 80 rupees to the public. So the public borrow that and paid his dues, and other firm again keep that money as a deposit. So that's coming to other bank. Let's say 80 rupees. Now the bank B got 80 rupees. They have to keep 20% with the central bank. Then 16 rupees goes. Then the balance 64 rupees only can be lent by bank B. Like that, every bank, it's a kind of rotations, right? Going around and around, right? Finally, like there will be a dead end. So how much a bank can lend? So what is the lending altogether? There's a formula, right? We call it deposit multiplier, DM. Deposit multiplier is 1 over SRR. That means 1 divided by 20%, 5 times, right? You can see the initial lending is 80 rupees. According to this calculation, the banks can lend 5 times of that additional credit. So that means 5 times means 400. So total credit creation actually like 500, right? Initial 100 plus 400, 500. Otherwise, you can calculate like this: 1 over SRR multiplied by your initial deposit. That means 1 over 20% multiplied by 100, that is 500 rupees. So this, when the banks can create credit based on the SRR many times of the deposits, that is we call deposit multiplier, right? Now let's look at this is the SRR. By changing the SRR, how you can change the credit creation capacity, right? Now let's assume commercial bank total deposit 100 as in the previous example, and SRR changes from 20% to 25%. What is the impact? If you use the formula and calculate, the bank can create additional credit is 300 rupees only. That means total credit is only 400. How do you calculate? You can calculate and see 1 over 25% multiplied by 100. That means the 400 rupees only you can create. So now bank credit is fallen by 25%. Right? So central bank can control bank credit through SRR. Clear? An additional point, now as we discussed this SRR, statutory reserve requirement or ratio, that money is with central bank. So the banks use this SRR as liquidity management tool, because in the event of financial crisis or bank is in trouble, they can utilize that money, right? So it's additional liquidity for banks. Up to now, we have seen quantitative measures. What are those? Open market operations, bank rate, and then SRR. So through these three mechanisms, actually, we can, the central bank can change money supply and try to promote economic activities. But in addition to that, there can be other qualitative measures or selective credit controls as well, right? That's the general one, because like you increase the money supply or credit creation capacity and see what happens. right? But through qualitative measures, right, the central bank can achieve some different things. Let's assume the entire credit market is in the same direction, right? Like credit market, so lending is in the same direction. The lending, right, can be, right, manipulated through these qualitative measures, right? Some through selective credit control. What are those? Maybe credit rationing, change in lending margin, moral suasion, or direct control. We can use these 4 qualitative measures, right, to reach our ultimate expectation. We will see one by one. What is mean by credit rationing? Right? Let's assume now you increase the money supply. Through that, you increase the credit creation capacity. But ultimately, we don't know, right, whether banks are lending those credits to the necessary sectors, or some sectors are isolated or neglected, or some sectors which need credit are excluded, right? So then the central bank can take qualitative measures to focus to fund the credit to the particular sectors. If some sectors neglected because of the too risky perception, now let's assume now agriculture sector is exposed to more risk than others because it's based on the weather conditions, right? So harvesting is anyway, it's very difficult to forecast. So many banks neglect this agriculture sector. They are reluctant to lend. So then central banks can say, no, you have to lend to agriculture sector. These are the priority sectors, or agriculture, or maybe fisheries, or small, medium scale entrepreneurs. So central bank can direct the banks to lend those priority sectors, right? So they also can like impose of upper limit on credit availability to less priority sectors, so they can say, no, don't lend to these sectors, right? You can go up to 10% or 20% of your lending portfolio. Or the central bank can say like charge higher interest rate on bank loan, right? So they can stop for less priority sectors, and they can ask banks to lend more for priority sectors, right? Now, second, that is first credit rationing, and second, change in lending margin. Now, central bank can say, you can lend only this much, right? Now, if they want to say, okay, you are going to buy a vehicle, the loan can given to buy this vehicle only the 70% of that vehicle value. So they can give a role on the lending margin. Or they can say, if you are going to buy stock, and if somebody is going to get a loan to invest on stocks, so central bank can say only you can give 60% of the stock value, right? So central bank can control the credit creation. right? Or credit availability. So sometimes this one works sometimes. So what central bank do is they conduct moral suasion. What do you mean by moral suasion? A method of persuading and convincing the commercial banks to advance credit in line with directives of central bank. Right? So central bank send the letters to banks or talk to the management and say you have to do this. Right? You have to lend. Right? You have to lend to agriculture sector. You have to lend to micro entrepreneurs. So they write to letters or have meetings, CEOs meetings, and explain the necessities and get them understand the situation. Through that also, central bank can have impact on credit creation. And finally, direct controls. When all of the methods prove ineffective, central bank resort to direct control measures with clear directives to carry out their lending activity in a specified manner, right? So if you have given all these avenues, but still banks are not doing as your expectation, then central bank clearly say, this is our stand, you have to do it. Direct controls, right? So banks should do that. So up to now, we have seen central bank can have quantitative measures or qualitative measures. Under quantitative measures, we have seen open market operations, bank rate, and SRR, right? Under qualitative measures, we have seen 4 items. One is credit rationing, other one is change in lending margin, and moral suasion and direct control. So these are the ways the central bank can have impact on credit creation, ultimately to achieve the goal of price stability, economic and price stability, right? Okay. Now, I always explain, now central bank initiate the policy measures, but that has to go to the bottom line, the general public behavior, and revive the economy. So how the transmission happens, right? So simply, I'm not going to get into more details, right? In simple way, there are two processes with the slide variances, you can see. Under Keynesian process, it says increasing money supply, right? When you increase the money supply, it increases the cash balances, right? When increase the cash balances, so then you increase the demand for financial assets, right? So I get more money, then I would like to buy financial assets, invest on financial assets. So what will happen? Fall in the interest rate, right? So increase in investment, so increase in the aggregate demand. That's what Keynesian process says, that flow. But in a monetarist process, increase in money supply, yes, increase cash balance, but that increase in demand for real assets. So nothing happened to the interest rate. Automatically aggregate demand increases. So different between these two processes are, right? The Keynesian process, aggregate demand changes due to change in the interest rate. But monetarist approach says aggregate demand increases without changing in interest rate. So we have to look into that both ways, right? Finally, like both as expected increase the aggregate demand if others are given, right? Clear? Okay. But we have to look into that, but still, even though we say everything is possible, but still there are limitations and effectiveness of monetary policy, right? So the limitations and effectiveness of monetary policy depends on following factors. One is time lag, other one is problem in forecasting, the third one is non-banking financial intermediaries, and fourth, underdeveloped money and capital market. These four items can limit the performance of monetary policy. Ultimately, you may not be able to achieve achieve your expectation, your goal, as expected, right? So first one, we see the time lag, right? The time lag can be two different time lag. One is, we call it inside lag, that is preparatory lag, and second is outside lag, the response lag. So when you say inside lag, that is the time taken to identify the nature of problem and the source of the problem and the assessing the magnitude of the problem and appropriate policy action and implementation of the policy action. So when you want to respond to a problem, first of all, you have to identify the nature. Now let's example, now the inflation is going up, right, beyond the expectation. So you have to first identify the problem, right? That's the inflation. Second, source of the problem, why that's happening, from which source it's emerging. And third, you have to assess the magnitude of the problem. So it's a serious one, or will be come back to normal, right? Or then if you see, okay, serious, we have to take action immediately. So what is the policy action we are going to take? Appropriate policy action. So there are so many policy actions. So which one we are going to choose? And then after choosing that, you have to implement correctly. So this take a lengthy time, right? And that is called inside lag. But after implementing, there may be time lag to see the impact, that is outside lag, right? So outside lag means the time taken by the households and firms to react to the policy action taken by the central bank. So because the ultimately, who is going to have the impact, that's a household and firms. That may be taking so long, right? Maybe 3 quarters, right? Because you increase the bank rate or reduce the bank rate. So bank should borrow from central bank, then lend to firms and household. They have to utilize the fund, and then to react that, you will have a time, right? That is outside lag. If the preparatory and operational lags are long, not only the nature and the magnitude of the problem may change, rendering the policy ineffective, but also it may worsen the situation. The problem is, like, if you take more time in preparation, right, before you implement the policy, right, the problem might have changed. Then the policy implementation may not be, that policy chosen policy may not be suitable for the problem now because its problem changed. So you can't take more time, right? We have to do it in a very short period, right? That's a time lag. and problems in forecasting, right? That is very problematic area, very complex, right? The formula of an appropriate monetary policy requires that the magnitude of the problem or recession or inflation is correctly assessed. The effects of monetary actions on microeconomics variable. It's not easy, right? And third, non-banking financial intermediaries. Now, huge share of non-bank financial intermediaries in total credit reduces the effectiveness of monetary policy, which works through banking finance. The problem is like this monetary policy works through bank finance, right? It's always go through banks. But if you have in your economy, if you have non-bank financial intermediaries, um, a bigger share of activities, so then this monetary policy may not be effective as per our expectation. And as I said earlier as well, underdeveloped money and capital market, right? The fragmented market, money and capital market may work like impact this monetary policy ineffective, right? Because the monetary policy transmission mechanism requires a well-developed, effective financial system, right? As I said, the speed of the transmission is very important. So if you have like well-developed financial market, then it quickly transmitted into the grassroots level. Okay, up to now, we have seen monetary policy, right? So you should be able to understand what is monetary policy and what's the purpose of monetary policy, and a central bank, how a central bank can implement monetary policy, what are the prerequisites, and how they can change the bank credit creation behavior, and ultimately how this can have impact on consumption, investment, price level, right? So I hope like you might have got a clear picture now, right? So hereafter I'm going to give you some kind of explanation around the monetary policy framework, right? So next, as we discussed earlier, right, it has several objectives, right, in the implementation of monetary policy. So based on the policy goals, the monetary policy framework can be categorized under different names. One is inflation targeting. That means the central bank targets inflation rate and conduct monetary policy to achieve that inflation rate. So central bank announce a target inflation rate, say like our target is 5%. So they try to maintain always 5%, or they can give a range of rates, maybe 4 to 6%, right? So so they forecast inflation rate, then directs their policies to steer actual inflation toward the targets. So it's a continuous mechanism, right? So it's country to country varies, but still this is one of the major development in the monetary policy environment. And second, exchange rate targeting. We are also discussed on the exchange rate analysis. So central bank can fix the exchange rate, right, and conduct monetary policy to achieve price stability through exchange rate, targeting exchange rate. Or some banks, central banks follow multiple indicators, right? So there may be interest rate, exchange rate, or some other indicators together they target, right, and conduct their monetary policy. And some central banks, they target nominal income. So they fix, okay, this is the income we have to achieve. So they conduct monetary policy to reach that nominal income target. Some central bank targets like money supply, we call it monetary targeting. So up to now in our discussion, we saw monetary targeting, right? The central bank controls money supply to achieve price stability. So in Sri Lanka, we were talking about inflation targeting, but still the monetary targeting is also considered actively. Yeah. I just want to give some explanation how monetary targeting in Sri Lanka works in the past, right? So since early 1980s, monetary management in Sri Lanka is based on monetary targeting framework, right? So the price stability is to be achieved by influencing changes in broad money supply, which is linked to reserve money through a multiplier, right? Reserve money is the operating target of monetary policy, right? The monetary targeting framework is operated through a monetary program, right? This is the Sri Lankan experience. So I will come back from the top to bottom. In Sri Lanka, the final objective, as I discussed earlier, the price and economic stability, right? So for monetary policy, what are the intermediate targets? They try to achieve monetary aggregates. That means broad money supply, right? They set a target and a broad money supply, and they try to achieve that. This is the intermediate target. So to achieve that intermediate target, the central bank sets operating targets, that is average weighted call money rate. So they try to achieve the operating target, right? They set the rates and try to achieve that. So what are the instruments they are using to achieve this, reach these operating targets? The policy rates and open market operations, reserve requirements, bank rate, and moralization. These are the instruments Central Bank of Sri Lanka used to achieve operating targets, then intermediate targets, and final objective of price and economic stability. So I also previously discussed about the monetary aggregates. I just recall this, right? The main definition of monetary aggregates that are considered in determining monetary policy and used to track monetary developments in Sri Lanka. Reserve money, when we say reserve money, that is base money or high powered money. And then M1, which is called narrow money, and M2 and M2B called broad money, linked to reserve money through money multiplier and broad money. So M4. So 4 types of aggregates are very often used to track the monetary developments, right? So in detail, what are these monetary aggregates include? When you say M1, that includes currency held by public and demand deposits held by public. So these all together called M1, right? When you say M2, M1 plus time and serving deposit held by the public, right? That is M2. M2B, M2 plus time and serving deposits held by the public with FCBUs. When you say FCBUs, it's foreign currency banking unit, or otherwise OBU. We can call it OBU, offshore banking unit. And M4 finally, M4 includes M2B plus time and serving deposits held by the public, take into consideration licensed specialized bank, and times and serving deposits held by the public from finance companies, right? So M4. So these are the 4 measures actively used in Sri Lanka, right? So when we talk about money supply, we assume like M1, and then wherever necessary, it can be M2, M2B, M4, right? In Sri Lanka, yes, the key instruments of monetary policy is OMO, SRR, bank rate, and sometimes ceiling of interest rate and moral suasion. So these are the key instruments used in Sri Lanka. We have studied what is this all about. So I just give a wrap up on the Sri Lankan monetary policy conduct, right? Okay, now open market operations. These operations involve the purchase or sales in open market of government securities or central bank conducts, or say or retiring of central bank securities to affect the liquidity in the bank system, right? We know this, we discussed. Okay. Why a central bank is conducting OMO? To reduce large fluctuation in the interbank interest rate, right? Okay. In our chart we saw, right? You can see, right? Average weighted call money rate is our operating target, right? So central bank try to influence, right? Who are the counterparties? Commercial banks and primary dealers. Means these are two people, like entities taking part in this OMO transaction. Under these OMO transactions, there are policy interest rates, right? One is, we call it standard deposit facility rate, SDFR. Another one is standard lending facility rate, right? Okay, so if the banks want to have deposit with central bank, they can get the return based on SDFR. If banks wants to get borrow from central bank, so they can get the lending at a rate set under SLFR, right? Standard lending facility rate. So normally, if you set these two rates, that we call it interest rate corridor, right? So upper limit is SLFR and lower limit is SDFR. So interest rate may be fluctuating between these two rates, right? So under open market operations, right? If central bank feels there's excess liquidity in the market, central bank sells government securities to the market, right? And absorb the excess liquidity from the banking system. On the other hand, if there's a liquidity shortage in the market, central bank buy government securities from the market and inject liquidity, new liquidity to the market. So this is the process of OMO. As I explained, right? So the central banks SDFR and SLFR form an interest rate corridor for the interbank call money market. The SDFR being the lower limit of that corridor and SLFR being the upper limit of the corridor. That's what I explained. So interest rate corridor reduce the potential large fluctuation in the short-term market interest rate, right? Okay, now currently, after this COVID-19, it has been reduced drastically, and because like banks can borrow money from central bank and lend it, so at a lower rate. So now it has been, SLFR is 5.5% and SDFR is 4.5%, right? Okay. And reserve requirement also, as we mentioned, like this is the percentage of deposits that the commercial banks are required to keep at central bank. At present, it's 2%, right? It was, I think, 5%, now brought down to 2%, right? And then bank rate, yes, the central bank lend to money to commercial bank, right? this is also reduced now. Now it's 8.5%. The banks can borrow, right? Kind of lender of last resort. If you have like urgent liquidity, the banks can go to central bank and borrow at 8.5%, right? How central bank make the decision, right? So you can see bottom to top, there's a department called Economic Research Department. They monitor, analyze, and reporting all these economic activities within the country and all these macroeconomic variables, and if there's an imbalance, so they get all this information. And they also, there's a committee called MPCC, that means Monetary Policy Consultative Committee. They get the expert advice from the private sector and include that, and they submit the report to the Monetary Policy Committee, MPC, right? So the Monetary Policy Committee review and make recommendation, then that is submitted to governor, then governor consider recommendation and analysis by the MPC, Monetary Policy Committee, right? Finally, that is submitted to Monetary Board, and Monetary Board will be the final decision makers on those recommendations. And this is the way a monetary policy decision is taken and implemented. And you can see very often this review happen after the monetary policy review. I just expand this one. Right. Okay, after this monetary policy review, the central bank do a press release. In that, it explain this the changes or like important aspect in the economy, what has happened during the past, and is there any issues or challenges, or what are the positive factors. So that explain, lot of explanation given. What I have given here is press release on 19 January 2021, latest one, right? This monetary policy review number 1, January 2021, the Central Bank of Sri Lanka continues its accommodative monetary policy stance. Now, if you understand the concept of monetary policy, what we have discussed, you should be able to read and understand this press release, right? So there may be like explanation for what's happened to the local economy, what's happened to the external sector, right? Everything is given. And finally, what is the decision of monetary board to promote economic and price stability. So in this, actually, you can see the title give the whole lot of meaning, right? Central Bank of Sri Lanka continue its accommodative monetary policy stance. That means like already the central bank monetary policy is accommodative, right? You could remember earlier, like I told you, like the monetary policy can be contractionary monetary policy or expansionary monetary policy, easing monetary policy, easing. So those are like, you know, an accommodative monetary policy. These are similar things. That means like, you know, to revive the economy, the central bank is going to give, you know, increase the money supply, right? And improve the economic activity. So the central bank is going to continue its stance in the future as well. That's what it says. So you can see the backup argument in the press release. And finally, the second page is fine, like page number 4. You can see I have given in the slides, right? So monetary policy decision, what is the policy decision is policy rates and SRR unchanged. So they are going to keep the policy rate and SRR unchanged, right? What are the policy rates? Right. As we discussed, standing deposit facility rates, SDFRs at 4.5%, and standing lending facility rate, SLFR, is 5.5%, and bank rate 8.5%, and SRR is 2%, right? So these are policy rate and SRR unchanged, right? So this is the final decision, monetary policy decision. Now you know what is monetary policy decision, right? So now you can recall all this discussion and think, okay, at this rate what will happen, right? This is what we study, right? So this is the final outcome of a monetary policy review, right? So now this will have a huge impact on the economy, right? Okay, so we have done monetary policy also today, right? So now next class we'll be looking at financial intermediaries and some kind of regulations. So next class will be the last class of mine, and thereafter it's your class will be continued by another lecturer, so for other subjects, right? The other chapters which is given in your syllabus. So you can ask any questions next class, and we can look into few questions, past questions, like how that could be answered if time permits. All right, is there any question? Okay, then we wind up this class today, and then see you next week. Thank you so much.